Poker and stocks. An unexpected parallel? The intense mind games at a poker table and the stock market, fluctuating wildly every second. Surprisingly, these two worlds share laws of success and failure. Like a mirror, they reflect each other, offering us crucial lessons. Today, we're diving into The Signal and the Noise, the renowned book by world-class data analyst Nate Silver. Through his comparison of poker and the stock market, we'll explore how we can make wiser judgments in a reality filled with uncertainty. Key lessons for today: the flow of new money, process over outcome. There are no secrets, only you know. Complacency is a pitfall. Through these 4 key lessons today, we'll gain insights to help us build unwavering investment principles, even in complex market situations. So, shall we begin with the first lesson? Main point 1. The influx of fish and the similarity to bubble bursts. Nate Silver points out that one of the crucial reasons poker tables thrive is the continuous influx of fish, beginners or less skilled players. The money they lose essentially fuels the game. If this flow of new money and players dwindles or stops, the game loses its vitality and eventually collapses. The stock market exhibits very similar patterns. When the market heats up and a bubble forms, we witness countless new investors jumping in with high hopes. Their capital pushes prices even higher. The so-called FOMO, or fear of missing out, further overheats the market. But no rally lasts forever. When the influx of new capital slows, or when existing investors start taking profits, or leave the market due to fear, the spectacular bubble can burst in an instant. Even those invested in successfully managed funds can suffer significant losses if they bought at the peak when things were hottest. The urge to get in now can be the most dangerous moment. This is the first warning poker gives to the stock market. Main point 2, process-oriented thinking in uncertainty. Is poker a game of skill or luck? The answer is both. Even the most skilled poker player can experience losing streaks for months on end because luck plays a powerful role. That's why true pros focus less on the short-term outcome of winning or losing each hand, and more on consistently maintaining a probabilistically advantageous process, making sound judgments and strategic bets. They know this is the key to long-term success. What about the stock market? With countless variables intertwining, short-term stock price prediction is nearly impossible. There's no guarantee that a stock hitting its upper limit today will rise again tomorrow. Even shares of excellent companies can fall in the short term due to market conditions or unforeseen events. If a prediction is wrong, you can never be sure whether it's due to a flaw in your model or simply bad luck. Therefore, it's necessary to maintain composure and devote all your energy to evaluating the reality of signals versus noise. So, like poker masters, we investors should focus less on the outcome of short-term price swings. Instead, we should concentrate on the process itself, adhering to our own investment principles, conducting thorough analysis, for example, assessing a company's intrinsic value, its fundamentals, and maintaining a long-term perspective. Ironically, letting go of an obsession with results can lead to better long-term outcomes. This is our second lesson. Training ourselves to make the best possible decisions with incomplete information is the essence of investing. Main point 3. There's no such thing as a secret only you know. Imagine you're at a poker game and you've spotted an opponent's specific habit, a tell, and you're consistently profiting from it. How long do you think that secret will last? It's highly likely that other observant players will soon notice that tell or even figure out that you're exploiting it. Eventually, that special signal you thought only you knew becomes common knowledge, noise, no longer an exclusive advantage. This principle applies directly to the stock market. If you think you've identified a unique pattern or piece of information and thought, this is it, a chance to make money, unfortunately, it's very probable that countless other smart investors and supercomputers faster than them have already found that pattern or will find it very soon. The signal you thought you discovered is likely already priced into the stock, or it quickly becomes widely known, turning into mere noise that no longer offers excess returns. This is one aspect of what economists call the efficient market hypothesis, and it's why, with the exception of a few masters like Warren Buffett, it's so incredibly difficult to consistently outperform the market average. Letting go of the illusion of secret information only I know is our third lesson. Main point 4, complacency is the surest path to failure. In poker, where a combination of skill and luck determines success, we tend to attribute failed predictions to bad luck and successful predictions to our own skill. Win big a few times at the poker table or achieve good results in a tournament, and it's easy to feel like you've mastered the game. Your shoulders broaden and complacency rears its head. But poker history is littered with geniuses who fell the moment they became complacent, thinking they knew all there was to know about poker. The market is always changing, and your opponents are also analyzing you and improving. This lesson is painfully relevant in investing too. After a few successful predictions or investments that yield significant profits, it's easy to delude yourself into thinking you have a special ability to predict the market. I'm an investment genius. This overconfidence is a very dangerous sign. Market conditions are different yesterday and today, and there's no guarantee that past success formulas will work in the future. When your predictions go wrong, instead of simply blaming bad luck by saying, "just wasn't my day," it's crucial to critically assess whether there were flaws in your analysis model or if you missed certain market changes. The moment you become intoxicated by success and stop self-reflecting, an unexpected downhill path can begin. Maintaining emotional discipline and constantly checking your cognitive biases is our fourth lesson. Conclusion: the journey of finding real signals in the noise. Ultimately, the core message Nate Silver conveys by comparing poker and the stock market in The Signal and the Noise is clear. The world we live in, especially the financial market, is uncertain and filled with a vast amount of noise. To discern the truly meaningful signals from this noise, to follow rational judgment rather than fleeting emotions, and to consistently adhere to a sound decision-making process from a long-term perspective rather than dwelling on short-term results. This is the ultimate wisdom we should pursue, whether at the poker table or in the volatile financial markets. I hope today's content has served as a small beacon on your investment journey. Understanding the market is not so different from understanding ourselves. I encourage you all to walk the path of successful investing through continuous learning and reflection. If you found this video helpful, please subscribe, like, and turn on notifications. Thank you for watching.